So there was a lot of clamor to have Rene from Fallacy Alarm back on the show. So I always respond to clamor. So Rene is back. We're going to be talking about the CPI. I just did a video on Monday morning. You might have seen it on Monday morning, talking about the fact that the number one reason I believe, this is Randy, believes that the market is headed upward is because inflation is headed downward. And you can almost chart it. When inflation started to go down last September, October, the market started up and it's continued up all along. Rene is here he may argue with me, he may agree with me, but he's got charts and graphs and he's got his own and definitely got opinions. Rene, glad to have you back on the show.
Yeah, thank you, Randy. I'm glad to be back.
Okay, great. Listen, if you like Rene on, this is the place, this is where if you hit like now or even later, that'll tell me that you like having Rene on. I can have him back more often. And then hit subscribe. There's great shows coming up later this week. We are going to do the 2024 analysis. That's going to be spread out. You'll be able to get that spreadsheet on Patreon. If you join Patreon, you'll be able to get that there. So let's just jump right into it, Rene. I am impressed. Do you follow Trueflation?
I do, yeah. It's a very, very interesting publication, yeah. And it kind of aligns with what we have been discussing too.
Right. And Trueflation right now is saying that inflation, the actual inflation rate based on day over day is at under 2.5 at this point.
Yeah, and that's a year over year figure, right? So
right. Yes.
It could be like the way it's dropping right now suggests that it's probably closer to zero, what they're measuring, yeah.
Right. And interestingly, on all the big numbers, all the major numbers like housing and transportation and energy, those are some of the ones that are at the lowest levels, even negative, according to Trueflation. Yeah. So anyway, what do you think of my thesis? My thesis is the market turned northward almost at exactly the same time as inflation started southward.
It seems to be that way, right? And I think we've had this theme for the entire year basically. And we will discuss in a moment also the last CPI report from May that paints exactly that picture. The impressive part about it is that it happens alongside an economy that is actually performing quite okay. It's not great, but it's also not a recession, and unemployment is also not high. So basically, I think the thesis here is that the Fed policy rate is just simply too high. They need to realize that. They need to adjust it down, and then we'll move on.
Then we'll really move on, huh? a little downward, a little relief in the rate of what they're charging us for our money. To borrow money would be a real help right now. Although I've made the comment. I've been watching interest rates for a very, very, very long time. I can remember paying 21% on my business loan, 21% back in, I forget what year that was, like 1982, 83, I think. So we've had much higher interest rates than this. And I do believe that business and even consumers get used to interest rates and start to figure out how to deal with high interest rates. Is that something that you found as well?
It could certainly happen. Yeah, I think we discussed it the last time as well, right? That at some point people will just stop their paralysis and just start buying cars and homes again. We'll see maybe the truth is maybe somewhere in the middle. A little bit comes down, but then people also get used to it.
All right. Do you want to dig into your analysis of the CPI report last week?
Okay. So I hope you can see a big table here.
Yeah.
Yeah. So this is the CPI report from last week for May. I will show this and then also some charts afterwards to make my point that I just outlined. So you can see here that in May, the CPI advanced by just 0.1%, and that obviously annualizes to less than 2%. So in May, we have been at the policy target level. And even if you average up all these monthly increases there from November to May, maybe you get to like an average of 0.2, maybe 0.3. So that's also a little bit, it's probably a little bit above the policy target, but not far off, and certainly not consistent with the 5% policy rate. So
Right.
looking at just headline alone already suggests that we're probably good, or like at least the policy rates are too high. And then, of course, people say, no, we have to look at the stickier components of the CPI report because this is distorted by energy, most importantly, coming down. And I would argue, that doesn't matter. The Fed's policy target is the entire CPI, not just certain components. It's not their target to get every component to like below 2%, right? And energy prices are coming down, like particularly for the reasons that the monetary policy has caused over the past year. They've made the US dollar scarcer, and then energy prices came down as a result of that. So it's part of their of the measures that they are taking, and we need to consider that we cannot just ignore it. And
I think the other thing is that I don't think necessarily in this particular environment, I can understand why they sometimes would think that the headline analysis was not the more important of the two, because energy and food are certainly more volatile. But in this environment, what we were talking about was a disruption in supply chains, which was creating a lot of the issues with both energy and certainly with foods, and also a lot of perceived problems that never took place. The war was supposed to create all these shortages of food, and those shortages never came about. But the price went up because people were anticipating that those price increases were going to take place. So I think maybe the Fed emphasis, on core is more misplaced than usual at this point.
Yeah, I would certainly agree with you there. But the problem is we have to deal with this argument anyway, because everyone is talking about it, right?
Yes.
So,
Yes.
and for me, usually the best way to fight an argument is to just take their assertion as a given, and then reason from there, and then invalidate it. And so
right.
that's what I'll try to do now, and we'll see how convincing that is for your audience.
Okay.
I highlighted some of this, the cells here. I believe what's most important to the story right now is the food inflation, the used cars, everyone is talking about them, and then of course the shelter component that is huge, and then also transportation services that you can see here at the bottom has been advancing at quite a rapid pace. So let's check those out: shelter, used cars, transportation services, and food.
Okay.
Let's start with the shelter component. It's 34% of the CPI, and it's even 42% of the core CPI. So a really big number, very important for the entire print. And most people in the US, they live in the homes that they own themselves. And then of course you cannot just look at the rent they're paying. So what the Fed then does is they look at a principle called owner's equivalent rent. And that basically is asking a sample pool of homeowners, if you had to or wanted to rent out your home, what would you think you can get for that? Just as a hypothetical question. So it's not an observation of something that's actually being paid. It's just asking someone's opinion. And because of this, historically, it has been difficult, or it has been expensive to collect the data, they're just asking 1/6 of the sample pool every month. So they ask every homeowner twice a year. And of course, this makes this measure very subjective. It's not really an observation, it's just asking for someone's opinion. And it's very biased because they may not be fully aware of what's going on in the market. And also maybe they are hoping they would get a better rent than what they would actually get, because they haven't market tested it. And of course, most importantly, it's lagging. So it takes like 12 to 18 months for a shock to be churned through the system.
So is there any understanding why CPI wouldn't be looking at such available information as Redfin and Zillow and other very good analysts of these kinds of things that are more real time and more accurate than asking a homeowner. Most homeowners wouldn't have a clue.
Honestly, I don't think there's a good argument for that. They've built this system like long time ago when we didn't have all these data available, and then I guess they're keeping this for consistency reasons. And it's a government agency. It takes a long time to improve something, right? So, but I think they should. It's kind of ridiculous that a third to a half of what they're looking at is based on such a, honestly, not helpful at all indicator.
Yeah.
So what I think then makes sense is to get a true picture, is because at some point, yes, this is a problem, but at some point with a huge lag, it will also get to the truth, right? Because at some point, people will actually catch up to where the rent level is, and they will not think forever that they can rent it out for a ridiculous amount. In a stable environment, I think this is not such a big problem because things kind of smooth out. But we went through an insane shock through the system with rents increasing 20-30% year over year at certain times during 2021. And that takes time in this measure to be digested. And at some point it will be fine, but for now it understated it on the way up and now it overstates it on the way down. But obviously we want to understand it more in real time, what is going on, and is this lower or higher than what this measure is telling us. And there's actually what I believe to be a very good indicator is the Zillow Zillow Observed Rent Indicator.
Okay.
And they provide this on a very big data set, basically for every city in the US. I don't know how many units they have, but certainly more units than what the CPI is surveying. And then they publish this measure. And they claim that they have smoothed it. But if you look at the raw data, and the chart that you're seeing here is what I have done with it. Their raw data is supposedly smooth, but you can see a clear seasonal pattern in their data, because people usually, they move in the spring, in the summer, they want to be in the new home when the school starts, stuff like that, right? So there's a lot of demand for rent in the spring and in the summer, and then it dies down in the winter. And so what I have done with this data set is I performed a seasonal adjustment myself.
Oh.
And I did that seasonal adjustment only on the period 2015 to 2019. Because what happened in 2020 was that usually when rent picks up in the spring, that was when the lockdowns happened and nobody moved anymore. So basically, my assumption is that after 2020, there's a lot of noise in the seasonal adjustment. So I didn't want to have that. So I performed a seasonal adjustment just based on the pattern that is visible from 2015 to 2019. And then I adjusted it. And the result is what you can see here. It's a month-over-month figure, annualized, which in my opinion is much better than looking at a year-over-year figure, for example, because it's more dynamic. You can see something quicker. I think it's the right number to look at. And you can see that most of the time, this increased at a pace of, let's say, 4% per year. And then it dropped down in 2020. And then it shot up like crazy with this, liquidity impulse that we had. And then it came down. And since the end of last year, we've been pretty much at 0 to 2%. So rents are not advancing faster than what the Fed would like them to advance. This is growing slower than it has grown for the second half of the 2010s. Yeah. And at some point, inevitably, this will show up in the CPI, right? It has to, because otherwise, at some point, people would think they can rent out like a $2,000 condo for like $5,000, and they would themselves realize, no, we cannot do that. So the CPI will show this. I don't know if it will show it in 3 months or in 12 months, but at some point it will show it. And then it will then be a headwind, because then it will be lagging again. And even if things are accelerating, this thing will drag it down. So once the shelter CPI has come down and has digested everything, it will become a headwind for future CPI prints. And this is what the data is clearly showing.
And interestingly, Trueflation, Zillow, Redfin, and several other indexes that I've looked at recently are almost exactly where you are. Somewhere between 0 and 2% seems to be where the rent increases are right now.
Yeah, doesn't surprise me at all to hear that. So yeah, let's move on then. This was obviously the most important component, but some of the other ones are relevant as well. Used cars is a very important topic that is very prominent. It doesn't have such a big impact on the CPI, but it certainly has a huge it's a huge focus on the public debate. And one thing that is important to note is that monetary policy cannot fix supply issues. If something gets scarcer and people pay more for it because there isn't as much of it as they want, then the price will go up, and you cannot change it with monetary policy.
Right.
And what we have, and what we have seen after 2020, with all these lockdowns and so on, supply chains got disrupted. Then we had the whole situation with Ukraine, of course, and the ship shortage that everyone talked about, and that really hit car production. You can see that here in the top chart. The blue line is the new car sales in the US, and you can see how that goes through like a boom and bust cycle. Yeah. And it has been very low since 2020. So usually there are like 17 million units sold in the US, but we have barely averaged like 13 million for the last 3 years. And I think a lot of that was supply driven. And then people couldn't buy the new cars weren't there that they wanted. And we talked about it, I think, in one of our previous conversations, that like the average age of the US vehicle fleet is very high, and people turn to used cars. You can see that here in the orange chart. That's the used car price, and these red vertical lines that I added here is where the new car sales bottomed. And you can see every time it bottomed, afterwards used car prices accelerated, because when there's less production, then people turn to the used car market, and there isn't much available in the used car market because production was low, and then used car prices accelerate. So clearly supply driven. And this is also what we have seen in the last years. And just today, and I apologize here, the title is, when I copied that in here, unfortunately, the title of the Mannheim non-seasonally adjusted used car prices that is hidden here. It just came out today for May. And there was a lot of talk recently, in the last 2 months or so, that used car prices are accelerating, and that may be a problem for the Fed. But again, I believe that this may be due to seasonal adjustments noise, because if you look at just year over year, so I think it's sometimes better to look at year over year instead of seasonally adjusting something, because then you don't have the noise. And you can see that at the bottom here, it has been falling since September of last year, and it has not accelerated at all. Every year-over-year print since September last year is lower than 1 year earlier. And today, in May 2023, we're lower than in May 2022, and we're barely higher than in May 2021. So most of this spike really was from, let's say, it mostly happened in 2021, and since then it has been a non-issue. And I don't know what's going on in the CPI used car index. Maybe it's lagging, maybe it's seasonal adjustments, I don't know. But again, eventually the reality will catch up, or it will catch up with the reality, and then we will see really low prints, and then people will talk about, oh my God, now it's a deflation problem. I don't know, it could be happening. So that's also, for me, clearly, it's not that people are going like crazy after used cars and the Fed needs to stop them. It's more like there are not enough cars to buy for people, so they pay more for them. And Jerome Powell cannot change that by increasing the interest rate.
It won't make a bit of difference. The used cars will be the same number no matter what he does.
Exactly, right? So, and eventually, like I'm convinced that policymakers do the right thing eventually, once they realize it, and they've exhausted all the other options, then they will do the right thing. And they have to they have to acknowledge this at some point, right?
Right.
Yeah. Then let's go to transportation services. And in my opinion, this is also supply driven. So for like 1 or 2 years or even longer, we couldn't travel, or at least it was very difficult for us to do so. I think there is a lot of pent up demand in traveling or general recreation spending. And that is happening. I think it happened last year, and it's also happening now. But still, we're at levels that are lower than what we've seen in the past. So the chart that I have here is the share of recreation services spending as a percentage of personal consumption expenditures. And you can see that this has been rising for decades because we spent more money on experiences, basically, right?
Sure.
This is a chart from my Airbnb article that I published recently, if anyone is interested. Yeah, but it's still recovering. So it seems like we want to spend more for recreation services of our, like all of, as a share of our total spending. But so far, we haven't been able to do so for whatever reason. And at this level, and I think over the past years, like airlines, hotels, like all these recreation activities, they have presumably reduced the capacity or the supply because they had to survive, basically.
Yes.
And then now you cannot ramp this up like from one day to another. So it takes time, and everyone wants to travel then this year. And last year we saw a similar effect, and I think it's still happening, but it's not there. Right? And again, monetary policy cannot create new planes and new hotel rooms and all these things. And maybe some of these recreation companies went bankrupt due to like lockdowns, and it takes time for then supply to catch up again. And it's again nothing that the Fed can change. So I believe
actually it's the opposite. If the Fed raises interest rates, business loans become more expensive, construction loans become more expensive, then all of a sudden people are not going to build as many planes, they're not going to build as many new recreational facilities, not as many hotels. So in fact, they're tamping down supply. I mean, that's kind of the whole point, is to tamp down the economy, which means you're tapping down supply. So it kind of has the opposite effect on some of these industries where it takes a long time. You don't build, Boeing can say tomorrow, American Airlines say tomorrow that they want another 1,000 planes, but they're not going to get them next Thursday.
Exactly, right? You're trying as a Fed, you're trying to stop demand, but you're also stopping supply.
Right.
So, yeah. But in the end, you want to match them, right? Yeah.
Right.
So yeah, it's a problem. And
but I will tell you that anecdotally, this recreational services this summer prices are just crazy. My son just took a trip from North Carolina to Seattle, and the best price he could get on Spirit Airlines was $12.50 round trip.
Wow. Yeah, I have a trip coming up with my son to Europe, and I think we paid $4,500 round trip.
Oh,
yeah. That was it's the worst time because with school and so on, I'm kind of a victim of this, but it's wild. So let's go to the next one that I want to talk about, which is food. And I think everyone has talked about that topic a lot. Go to the supermarket, and then whatever you buy, it's again like $1 more. And like if something goes from $2 to $3, it's a pretty big increase, percentage wise, of course. And you saw initially in the first chart in May, it has just increased by 2% annualized. So there was no excess inflation in food in May, right? So that's, like, I want to say that up front. But then the other aspect of it is, I believe there is what people are able to or willing to pay, and then also how much of that companies are able to then push into the market. Because you might often, even if people are willing to pay $10 for a bar of chocolate, you cannot just raise it from $2 to $10 because they will be upset. They will be offended. You cannot do that. But over the past 2 years, the public has accepted that prices increase rapidly because they're increasing everywhere. And then companies took advantage of that and they just increased prices. And I think this concept has been popularized as greedflation. I think politicians have called it greedflation because companies take advantage. And I think there is a limit to that. And I think there's a natural equilibrium price that customers are willing and able to pay. And the more companies raise their prices, the less headroom they have to do that in the future. And so I believe that at some point, these price increases it's a process that will stop itself because they've done all the price increases that they wanted to do in a very short period of time, and then they hit a wall. And I believe that will eventually will happen. You can see that here in the chart that I got that from another Substack, the transcript.substack.com. So this is a summary of Q1 financial disclosures from a bunch of consumer companies and how they have increased their prices and their volume. And the point that this Substack here wanted to make is they are raising the prices, and at the same time they're okay with dropping the volumes because it works for them. And I think this is a process that cannot go on forever. So I believe the price increases of today in the food or in the general in the consumer market is like a headwind in the future for the CPI because they cannot repeat this forever.
Right.
Because the income of people's income is not there.
I think just to make a sidebar, because I've been in the supply chain my entire career, owned a manufacturing company for 30 years, distribution companies, import, export, et cetera. And it has it has a little bit to do with greed. You're always going to want to maximize the amount that you're charging to the market. I mean, you'd be foolish not to maximize the amount that you can charge, but you're always looking over your shoulder at your competitors, and those are not always direct competitors. It doesn't just mean Coca-Cola and Pepsi. It means every other drink out there, including water. You're always looking at the competition. You're always dealing with a buyer someplace along the line. Coca-Cola is dealing with a buyer at Ralph's who's saying, no, I'm not going to pay more, and beating them up for, to get the price down. Then, as you point out, then you have the consumer who finally says, no, I'm sorry, I'm not going to pay that price. And most of these companies at this point are super sensitive to this kind of information. If they don't get it anywhere else, they get it at Walmart. Walmart is giving them information they can practically get information on a day-by-day basis in terms of what is actually moving off the shelves by region and nationwide. So you get such amazing feedback that you can quickly make changes in pricing based on what the consumer is saying.
Yeah, exactly. And then people at some point find substitutes.
That's right.
Inevitable. And that will happen. And maybe it's happening already. Again, inflation for food was 2% annualized in May. We'll see how this goes on going forward. So we'll see how it goes. But in general, I think the picture that the entire inflation report is painting is inflation is really a non-issue. We might have to deal with deflation going forward. The one thing I believe that stops the whole deflation spiral to start is this crazy fiscal spending that we have. I mean, we're still at almost like $2 trillion that they spend on an annual basis, which is honestly absurd if you compare that to recent historical levels. It's still like emergency COVID spending basically that they're running. So that is kind of an inflationary driver. But even with this inflationary driver, we're seeing here in the CPI that the whole story is falling apart. And what if they ever reduce that a little bit, right? That's basically my recap of the CPI report.
So your general feeling would be then that that this deflationary, or not deflationary, but the inflation trend will continue down. Do you think we'll get to zero? Will we overshoot the 2%? And then the Fed will be forced to lower rates?
I think they will be forced to lower rates even if current situation remains, because you cannot have basically 2% inflation and 5% policy rate. That doesn't make sense.
Right.
But this whole shelter component, I think it will have to go negative at some point. And then you have a component that is 30, 40, 50% of the measure that you're looking at as a Fed, and that is negative. I would not be surprised if the CPI year over year goes sub-zero over the next, let's say, 12 months. But even if it doesn't, the Fed funds rate has to come down a lot. And
so I saw another report this morning that showed that people still have more money in their checking account across all levels of income. Everybody has more money in their checking account today than they did pre-pandemic. So even though it went way up during the pandemic because they were getting all this money in, they have not gone back to living paycheck to paycheck as much as normal. So with that kind of money in people's hands, there is a tendency I think we do have to recognize there's a real tendency for people to want to spend, especially if there's pent-up demand, like an automobile, for instance. So the inflationary pressures might still be there, at least enough to keep us in the Fed's range of 0 to 2%. But the countervailing thing, which a lot of folks fail to take into consideration, I'm sure you know I'm a big Cathie Wood fan, the countervailing aspect is technology is making things less expensive to produce. And at a certain point, once again, competitive pressures force companies to lower their prices because they're able to. And when one company is able to, and their competitor hasn't lowered it yet, there's almost an automatic. Yeah. People are going to try to grab market share if they think they can get away with it, and then that's going to. So there's the greed factor, but there's also the I want more market share, which is, I guess, a greed factor, which causes companies to lower prices if they're in a position to do so, and their competitor isn't.
And to your first point, you could even spin these enormous cash levels as a deflationary or disinflationary argument, because it is true, US households currently have $4 trillion in checking accounts, which is 4 times more than they had pre-pandemic. And I think the fear was always, what if all this money printed, what if that becomes effective and people start buying things? But they're not, right? The inflation story is falling apart even with these excessive cash levels. So people, if we go into a recession from here, it will be because people don't want to spend, not because they can't. And because they can't was the reason 15 years ago. And now it's about because they don't want to. And what do you do with an economy that spirals into a recession because people don't want to spend? You stimulate it. And you know how that will play out.
And then again, something I pay a ton of attention to, and most people don't. Most people, I don't know why this is. People don't want to look at demographics, maybe because it's so mathematical, and most people don't hate math. I don't know if that's it, but for some reason, maybe I've had this conversation with you before. I'm sure I've said it on the show before. Is about back in the 70s. It was obvious that the baby boom was over, and they kept building grade schools. It's like it doesn't take a genius to see that from 1964 to 1965, there was 1 million less babies born. And if you got 1 million less babies born, that means 5 years from now, you're not going to be. There's not going to be those million people are not going to be in kindergarten. And so these kinds of things are so easy to see. Elon's been talking about it now. The pressure on the population is not upward, it's downward. But we also have to look at the nature of the human beast in a demographic switch like we've had. What do people over 50 spend their money on? They're no longer spending on trinkets. They're no longer spending it even on food in the house. They're spending it on travel, and they're spending it on a nicer car, and they're spending it on going out to eat. So those are the places that are going to be seeing some inflationary pressure, and some of these other things, like even eventually housing. I see as the population ages and gets smaller, there's a time in the future where we may start to see deflationary pressure on residential housing.
Possible, yeah.
Yeah. Well, okay. Any summary? Any last word on your brilliant analysis here?
Yeah, I think it's as outlined in the beginning. Seems to me like the inflation story is coming to an end without breaking the labor market or the economy. So my assumption is that the Fed will simply adjust the rates down once they realize that, and there will probably be some turbulences associated with that, but I believe that there's more upside because of this than downside. I think that's my conclusion.
Okay, well, I think we agree. Look at that. All right. Well, listen, Rene, another great presentation. Appreciate the detail and the unique perspective, and the fact that you've done your own analysis and provided us with basically the numbers to prove your analysis. So again, this is the time. Hit that like button if you, like I, thought that Rene did an amazing job in bringing us this new version, this kind of different look. Hit subscribe, hit notify if you want to be able to make sure you. Rene and I have another. He puts out a newsletter. Can people sign up for your newsletter?
Yeah, you can just check that out at fallacyalarm.com. I send out an email about once a week. Okay,
at fallacyalarm.com. And the newsletters are great. In fact, one of the ones he came out with Saturday, we're definitely going to do another show on. It talks. Give us a hint. It's the something about the way investors think or something. How does it? Help me out.
Yeah, I think it's important to look at positioning too, because how much leverage is in the system or how much short interest is in the system determines then the tides of liquidity and leveraging up and deleveraging that causes the boom and bust in markets. And what I have done is, because in my opinion there was like a lack of availability of data, like comprehensive data and insightful data, I took the CFTC's Commitment of Traders report, and then I summarized like all the longs and short positions in the 18 most important underlyings of traders and how they are net long over time. And you can see that, for example, they were very short in the S&P, which I think, then I wrote about that before as well, and I anticipated that there would be sort of a short squeeze coming up, which I think we have seen now. And as part of this whole option expiry event that we had last week, they have closed all these short positions. So that was an important takeaway. And then in general, I think you can, for example, look at short volatility bets. They are below average levels. And I also summarized some of the FX positioning, international positioning, commodities, and all these things you can find in there.
Yeah, so it's all about investor commitment. I thought it was a great subject. So I think, maybe next week we'll have a video with you where we'll talk about investor commitment. How committed are you? Most of us need to be committed. I know that for a fact. Okay, this is Randy Kirk, and it's been great to have Rene on. And at the same time, it's been great talking to all of you.
Thank you, Randy.
Click the link below to get your paperback, Kindle, or audiobook now.